we're going to take a little bit of time here, take a look at the indicators, and also this is coming into a very positive seasonal time of the year as well. So we'll talk about that a little bit. Just before we get started, our firm, we have three aspects. We're money manager, both CTA and registered investment advisor. We put out a number of newsletters and sell a lot of research on our website, as well as directly. And then we have an option education division doing webinars like this or mentoring as well. So I'll come back to this later, but we will be sending you the PDFs of these of today's presentation. The reason I say PDFs is because one is in color and one is in grayscale. So if you print it out, you don't use up all the ink in your printer. So let's get started. The four main things we look at, although you'll find that we look at a few other things as well, is number one, the chart of the S&P. Equity only put call ratios, both in terms of the broad market as well as individual stocks and futures. Market breadth, we have a couple of option oriented ways of looking at that. And then the entire volatility complex, VIX, and all the things that go along with that, VIX futures, VIX options, etc. So I have an important rule with a corollary, and that rule is oversold does not mean buy. So the market can continue down quite a while when it gets oversold. Recently, it hasn't done that, but it certainly did that last April. And then the corollary is overbought does not mean sell. So we were overbought in October, certainly heading into this most recent sort of correction that we had. And but we were overbought really probably even as long ago as July, August, but the market continued higher for a couple of months before you actually got sell signals. So let's start out with looking at the long-term chart. It's a pretty bullish chart, except for that nasty drop last April, the tariff tantrum or whatever you want to call it. Down 21% in 37 trading days, extremely quick correction and then recovery. It's been a monster recovery. These little circles there are gaps on the chart. I really don't expect them to be filled. But we traded all the way up to 6,900 in late October. And since then, we're bouncing around 6,500 seems to be pretty good support right in here. It's held many times. We've probably, I think, about 8 times. And so that's along that area. And then on the high side, we haven't quite got all the way back to 6,900, but we're in a trading range there. And we haven't had really a meaningful correction since April. So we're probably due for one, but corrections typically don't occur in December, be more like into the new year probably. This is the same chart, only zoomed in a little bit. It's a 1-year chart. The only really big difference on this chart is you can see that there was support. We bounced off of 6,200 a few times back there, so that was support and never got tested again since last summer. But now 6,200 is where the 200-day moving average is. So for some reason, we were to break down out of this trading range to the downside, we're probably going to find some support anyways near 6,200. So just to kind of summarize that, we've been in this 6,500 to 6,900 trading range now for several weeks, and as a result, we're getting mixed indicators as you'll see. But you could try to trade SPX within the trading range or wait for a breakout. It's certainly been profitable to buy near 6,500. And the one time we got up near 6,900, of course, it was profitable to sell there as well. So we'll see how this continues to develop, but certainly a breakout is a tradable fact. Another thing we do with the S&P chart is we draw Bollinger Bands on it. Now, these are modified Bollinger Bands. When John Bollinger first invented Bollinger Bands, you need a realized volatility component. And he defined realized volatility as the standard deviation of closing prices. And that's certainly reasonable, but that's not what the math guys use, like Black-Scholes, and that they use the standard deviation of daily percentage price changes, which is slightly different. But we're in the option business, and so we need our implied volatilities coming out of the models to line up with the realized volatilities. Otherwise, you can't compare them. And so we use that Black-Scholes definition of realized volatility. So we draw those bands, modified Bollinger Bands, on the S&P chart, and when we move outside of plus or minus 4 standard deviations, it sets up a trade. So here's the last year, and the red letters are successful signals, the blue letters are not. So on a successful signal, let's just take the most recent one that just concluded here. I'm trying to find my, oh, there it is. Sorry. So this one, we moved outside the plus 4 sigma. The top band there is plus 4 sigma, and then we moved back inside plus 3 sigma. That gave us a sell signal. We eventually felt and touched the minus 4 standard deviation band a couple of weeks ago, and so that completed that signal. The blue letters are ones that we were stopped out of. That we have a trading system built around these. Typically, we would have a lot more red letters than blue letters, but that's not been the case this year. It kept riding along the upper bands, occasionally going above it, but not really ever pulling all the way back to the lower band until just last week. You can see, I'm going to just erase what I drew there so you can see it a little better. You can see how the bands have widened out. They were fairly close together over here, which is part of the reason we were getting so many signals, but now they're quite a ways apart over here. Realized volatility jumped tremendously on that one big down day we had there on October 10th, which is when President Trump threatened tariffs on China. It caused another mini tariff tantrum in the market, and it really hasn't slowed down since, because the market, we've had S&P then quickly recovered relative to the new high, then fell all the way down to the bottom of the trading range, and then it quickly recovered almost the entire distance of the trading range in just a few days. So that kind of movement is keeping realized volatility high, and so the bands are pretty far apart. So right now we don't have a signal from this indicator. It's sitting at neutral, in a neutral state, waiting to move either outside of the plus or minus 4 standard deviation band. So that just more or less summarizes it. If you take up our offer to subscribe to our newsletters, you'll see the long-term track record of the MVB signals. They have been very successful over the years. Now we can do the same concept outside, moving outside the 4 standard deviation band on any chart. It doesn't have to be the S&P. And so we have a subscription service where we run these calculations daily and tell you where things are moving outside of bands. This is what it looks like. It runs through TradingView. You can see the signals that this is the same chart we just looked at, except the other one was drawn with our software and not the software of the TradingView. But you can see the little green, buy signals and then the red sell signals as we go along. So it lines up exactly with the other one. Now here's an interesting one. We just got a buy signal in Coinbase. You know, that thing has been under a lot of pressure. There was a sell signal back in mid-October, I guess it is. And so that led to a decline. We finally hit the minus 4 standard deviation band right there that terminated that sell signal. And then we quickly have come back and now generated a new buy signal here. So that's sort of an interesting one. Another one, American Eagle Outfitters. A couple of our traders that work for us follow these pretty closely. This is when they were on recently, and they got a boost there with the earnings last week. That thing gapped to the upside. Anyway, so let's move on to the next subject, which is put-call ratios. Put-call ratios were first invented by Marty Zweig back in the 1950s as a well, at first he thought it was going to be a direct indicator of the market, but it turned out it's a reverse indicator, converse indicator. So, but we use the equity only put call ratio. That's all stock options that trade to predict the broad market. I'll show you why in a minute. But what Marty found was when he started looking at this data, his data was gathered by the ads that ran in Barron's every Sunday. They put in call dealers would run these ads listing how many puts and calls they traded. He found that if there was a lot of put buying going on, rather than the market going down, he found the market went up. This was not smart money buying the puts. So it's a contrary indicator. Similarly, if we found too much call buying was going on, pretty soon the market went down. So, of course, quantifying what too much is what we attempt to do. And typically, we publish on our website in an area called the Strategy Zone. We publish about 1,600 or more put-call ratio charts every day. And each chart has two components. The stock price is on the top, and the put-call ratio chart is below that. And typically they would have this inverse pattern. So let's just see, how where these signals will come in. Let's say the stock is declining. So as the stock is declining, people are buying puts. So the put-call ratio goes up when put volume dominates over call volume. Eventually, though, you reach a local maximum, and a local maximum on the put-call ratio is a buy signal for the stock. Now the stock starts to go up. We go to the left side, as the stock is still going up. People are buying calls. That forces the put call ratio to go lower and lower. And eventually you get to a local minimum on the put call ratio chart, and that is a sell signal for the stock. So the reason we give you both graphs is that you can look at that. If you don't see this inverse pattern, then perhaps something else is going on. It typically would be arbitrage, or whether it's simple like dividend arbitrage or perhaps takeover arbitrage, things that will distort the let's say speculative nature. The speculators are what gives us the contrary opinion, not arbitrageurs doing arbitrage. So this is on top the S&P 500. This is not a current chart, by the way. And on the bottom is the equity only put call ratio, all stock options that trade. And you can see the inverse symmetry here. That's why we use the equity only put call ratio to predict where the broad market is going. So where are we right now? So this is the current chart, and you can see that we had a local minimum here in October, and we're basically still operating off of that. Even though the market's in a trading range, the put call ratio is still going higher. Now you can see it's kind of slowed down here, and we have a computer analysis programs that look at this sort of like a chess playing tree. You can look out a few moves ahead, and it's looking for this thing to roll over. That would be a buy signal. That would be a local maximum that we had back here, or even better, the one in April here. But that hasn't happened yet. In fact, the computer analysis programs are saying it doesn't look like it's going to happen, that this is probably going to continue higher before it rolls over. But in any case, the sell signal is marked in green because it's open. It's an open trade. The red signals are successful ones. The red letters are successful ones. The blue ones are not. Typically, this is a pretty good ratio, a pretty good indicator, especially when it gets to extremes. This last one was the lowest. The sell signal came in at the lowest put call ratio since November of 2021, which is, you may recall, is right, a couple months before bear market started. So I'm not saying that's happening now. I'm going to show you a longer term chart in a minute. But in any case, this is on a sell signal. So this is what we call the standard put call ratio, where we just take the volume of puts divided by the volume of calls to get the put call ratio. But we can also compute a weighted put call ratio. We look at the dollar volume of puts that trade divided by the dollar volume of calls that trade. So that's sometimes called the dollar weighted put call ratio, more simply just the weighted put call ratio. These signals occur pretty much at the same place, same in time. You can see again the open sell signal there. This one, looks like it might be rolling over too, but again, the computer program says no. Great buy signal last April up in here, but this one did not quite reach the lows from 2021 that occurred earlier in the year back here. These lows right here were the lowest we'd been since 2021. But in any case, this is still on a sell signal as well. So these, these are typically an indicator where we'll put on a position, perhaps a longer term position, and just sit with it. You don't get that many trades a year. You see from the chart, maybe 5 or 6 trades a year. And right now, we're still on this sell signal. The rate of ascent is slowed, as I said, but that doesn't make a sell signal out of it, not yet. Now, here's the longer term chart. This is going back 8 years with the standard ratio. Over to the right here is where we just, what we were just looking at, the this general, I'd say this area probably about right there is what we were just looking at. But you can see we're going back during the pandemic, the ratio got much higher, all the way up in here. And then after we came out of the pandemic, it fell to a very low level and stayed there for quite a while. So I call that extreme optimism. And when I said just a few minutes ago that with this, the current ratio has been the lowest that it had been since 2021. That's what this red line here is showing. To show you where it was low before, and then comparing that, going all the way back here to 2021, you can see that not only was it lower back then, but it was quite a bit lower, and for quite a while, it stayed down there for a long time. So yes, we certainly got to an extreme in optimism here in October. Is it the start of something that's going to set off a bear market like that last extreme optimism back there in 2021 did? Yeah, that's not clear. That we weren't that optimistic for that long of a period of time. The weighted put call ratio looks like this. Again, over on the right is what we were just looking at in terms of the recent last year or so. This is a much longer term chart. You can see that there was a very high reading here during the end of the bear market in 2022. Also a high reading back during the financial crisis. And the pandemic is also in here, but it's not quite as high as the others. In this chart, the weighted put call ratio chart seems to exhibit optimism when it gets down around 50. The scale on the left of 50 means $50 worth of puts are traded for every $100 worth of calls. So that's pretty optimistic. And again, this is stock options now, not index options. So we got down to that level, and it's part of the reason we've fallen into the trading range. There was just a little bit too much optimism there in October. So what do we trade when we get these signals like an MVB, a volatility band signal, or a put call ratio signal? So I like to buy a slightly in the money option because the delta on that is higher. So if I'm predicting where the underlying is going, and my delta and my option has a fairly high delta, then my option is going to make money. It's going to follow along. If I buy something too far out of the money with a small delta, it becomes much more like a lottery ticket or something like that. Now, on TV, almost every time they talk about buying a position, they spread it, and that you shouldn't do that, no. But they do. But what I mean by spread, they'll buy a call at a lower strike, and if they're bullish on the stock, and instead of just being satisfied with that, they seem to always want to sell a call at a higher strike. So it's all well and good when the stock is between the two, but once it gets to the higher strike, that's it. You've capped off your profit potential. Well, that's a pretty restrictive thing to do to yourself. And if you hit a big winner, you're going to be very unhappy that you capped off your profit potential. Now, there is a time to do that, and that's when volatility is high. And again, on that area of our website that we call the strategy zone, we have daily updates on all kinds of volatility on everything that trades options. And once a week, we update that for free on our website as well. So you can go there and take a look at all the historical and implied volatilities, essentially of everything that trades options. So when implied volatility is high, a bull spread does make some sense. But the proponents usually say, well, you're risking less. You're not risking less. You're risking 100% of what you put up. Whether you buy a call or you buy a bull spread, in either case, your broker is going to ask you to pay for that in full, and that is all at risk. So it's 100% risk. Now, dollar-wise, you might be risking a little bit more with the spread, but if you don't spread and the market goes up this high, the underlying goes up that high, you have a lot of profit potential to the upside. So instead of, let's say, buying, maybe instead of buying 5 bull spreads, maybe you buy 4 calls or something if you're really worried about the dollar risk. But your percentage risk is 100% in both cases. Now, sometimes, as I said, it does pay to, or it does, the math dictates that you do a spread. You can mitigate the negative aspects of spreading in 2 ways. One is widen the difference in the strike. So if we're trading SPY calls, like if we're buying, a position based on the MVB or the put call ratio, we'll be buying SPY calls 1 or 2 points in the money, typically fairly short term, 2 or 3 weeks out in time. So right now, if I'm buying a SPY call expiring later than December 19th, I'm going to spread it 15 to 20 points wide because the implied volatilities out there are still pretty high. But if I'm doing puts, I'm going to spread those 30 or 40 points wide because the implied volatility of puts is higher than calls where both are equally out of the money. Prior to December 19th, now with VIX having fallen back, if you're buying a shorter term call, I don't think you really need to spread that. The second way to mitigate the negative aspects of a spread is to roll if the short strike is hit. So I'll give you an example of that. So today SPY was near 680, it's a little above that. And let's say you wanted to take a position out in January. So you buy the SPY 680 call and you sell the SPY 700 call 20 points wide out in January. So that's your bull spread. And now what I recommend doing, and this is what we do in our newsletters, if you are fortunate enough to have it get up to 700, then you sell that spread you bought before, take the profit on it, and move into the next higher spread, moves both strikes up 20 points. So your original spread was, based on a profit graph like this. By the time you get up to here, which this would be the 700, the top of the spread, there's not a whole lot of profit potential left. There's a little, but not much. In fact, I drew this graph here. So if you start out in the black spread, the lower strike, 680, 700, your profit potential is along this black line right there. But once you get to 700, you sell that spread, take that profit, and then you buy the red spread, the bull spread, still do a bull spread. And now your profit potential has moved on to this line. And again, if you get to 720, you do it again and again. And so you can continue to make money on the upside, keep raising your profitability on the upside, and you put some money in your pocket along the way too. So it still won't be as much as if you just bought a call and held it in the first place, but this is a very reasonable approach that we use successfully in our newsletter positions, particularly in SPY, but sometimes in other things as well. For example, like right now we just bought a spread in gold, and very expensive options there, so we spread them rather than just buy a call. On the put side, well, this is still the call example. So just to show you the sort of distortion that's going on in the pricing right now, with interest rates are still, modestly high. So a 680 call will cost you 1630, and a 700 call will bring in 600. So if we're buying this and selling this, we're paying a debit of 1030. But the best we can do is have that widen out to 20. Well, that's a nice percentage gain, but for an option position, it's not all that great. However, if we look at puts, it works better, really. Again, with the put situation, again, I said there we would spread it 30 or 40 points wide. So if we're buying the Jan 680 put, we would sell the Jan 640 put. That's the prices for those. A total difference between the two is $7.50. So now we're paying a $7.50 debit for a potential for it to widen out to 40. Now that's much better for an option position. But this is due to to a large part extent with interest rates and of course implied volatilities. But in this particular case, since we have a 40-point wide put spread, if S&P or SPY were to trade down to 640, then we'd sell that spread and buy a new one with 640 and 600 as the strike. So same concept works both for puts and calls. Let's take a look at some individual put-call ratio charts. When I'm looking at individual put-call ratio charts, though, I only use the extreme signals, the extreme maximum minimum. So like right here, that's a local maximum, but that I wouldn't consider a buy signal. But these out here I would. So this is ARC Innovation, ARC K, and you can see that buy signal there was a little premature, but then it got in gear and took off to the upside. And we just got a new one now just late last week where we got a local maximum there that's confirmed with the computer analysis program, and you can see it's an extreme level. It's up in the 300 neighborhood, meaning $300 worth of puts are being bought for every $100 worth of calls. So that's a lot of pessimism. People very pessimistic on the holdings of this fund. And so that gives us a contrary buy signal. There was also a sell signal back in October here on this local minimum was at an extreme, and that sell signal was pretty good, but rather short-lived. Another one that we just got into, I mentioned, it was gold, the gold ETF. And this is sort of interesting. So you had this extreme high on the put-call ratio chart there, and that was a good buy signal, lasts for quite some time. Then you had another one in August, and that really set off this big thing to the upside. But that really resulted in call buyers getting carried away, and you got a sell signal in October. But that quickly drew in the put buyers. So a lot of people were waiting for this thing to fail. I guess this modest correction right there was all they needed to see, and they bloated up on the puts. And now we've got a contrary buy signal, a local maximum, like people are exhausted from buying all these puts, and so the put call ratio is rolling over to a local maximum, and so that's a buy signal there. Probably even more extreme one here in the silver ETF, same thing. We got a buy signal in mid-November just recently, and that's off to the races as well. Just a couple of others. Avery, this is one we just put out last week. That's a sell signal and hasn't really fallen much yet, but you can see from a similar level about a year ago, it was a good sell signal. So I do look to try to see whether it's been successful in the past or not. We can do the same thing with futures. Now, on the bottom here, the put-call ratio chart is drawn using the T-bond futures options that trade on the Chicago Board of Trade. So those are futures options, and you may or may not have a futures account, but you can certainly use them as a signal. And then once the signal occurs, you can trade this ETF. TLT is an ETF that simulates the long bond. In fact, they own the long bond futures in that ETF or the equivalent thereof. So the TLT moves just like the long bonds would. On top, the stock price chart, stock is in quotes, futures price chart is a continuous chart of the T-bond futures. But sometimes you'll get a futures signal that you just can't trade. So this is Cocoa, gave a buy signal right at the beginning of November, but there was, you can't find, there is no ETF that simulates Cocoa, so you actually do have to go trade the futures option there on the ICE exchange if you want to take advantage of that signal. All right, so let's move on to market breadth. Market breadth is interesting. We can keep track of advances minus declines. We can keep a coupon. That is and they keep a running total of advances minus declines. And we look at breadth also as an oscillator, where yesterday's value or today's value is 90% of yesterday's value plus 10% of today's advances minus declines. So that gives us, you know, a chart that looks like this. A lot of overbought conditions in the last 10 years as the market has mostly gone up. Not too many oversold conditions except during the bear market of, you know, when we got into the bear market in 2022. We had a lot more oversold conditions, but there were a couple of nasty ones, of course. This is December 2018. That's the pandemic, etc. And then this last April, we had that one. And then just recently there in October, we did get down there and we got a buy signal just last week from this oscillator. So now it's already moved into overbought territory, but you know, that's good. We don't consider overbought as a sell signal. We're just hoping that it continue to run. So this is bullish. Unfortunately, the New York's, this is based on stocks only, breadth. By stocks only, I mean all stocks that have listed options, over 6,000 of those. But you can also calculate the same things with New York Stock Exchange data. And unfortunately, New York Stock Exchange oscillator already rolled back to a sell signal. One thing that was negative pretty much all during this last rally since April is that breadth has really not been all that great in terms of individual issues. It's really because, you know, people are concentrating in the Magnificent Seven or what have you. So if we look at volume breadth, the volume of advancing issues minus the volume of declining issues, it looks much better. It's made new highs right along with SPX all summer long. The last time was in October 27th, so not in the last month. And eventually, when a bear market starts, we may see a divergence from this indicator, but there's no sign of that at the current time. So the volume breadth is on top, and that vertical yellow line shows that volume breadth went to a new all-time high last June before the S&P did. Then the S&P, or actually May, I think it was, but then S&P caught up. So in that way, it's a predictive indicator as well. So right now, that's still rolling along to the upside. It's not too far from an all-time high, just like SPX is not too far from an all-time high. So we also follow new highs versus new lows, and on the right there at the top, I say infrequent signals, and they typically have been infrequent signals. But on the left, all those colored areas, it's switching back and forth from buy to sell to buy to sell, and I don't think I've ever really seen this indicator have that much of a problem. This was a sell signal, then a buy signal, then a sell signal, and then a buy signal. So right now we're on a buy signal as of the 26th, last Wednesday, and you know, it's hard to imagine that many stocks are near all 52-week highs at the same time as an equal number of stocks near 52-week lows. But that's what a situation we're in right now. So regardless, this is on a buy signal right now. So let's take a look at VIX. The trend of VIX is important, should be trending opposite to the market. And also spike peaks are buy signals for VIX. So this is the VIX chart going back this whole last year. And we spiked up here when we had that little correction there in November 20th or so. We spiked up to almost 29, maybe a little, you know, I think it was just about 29 on VIX, and then back down. So that's a buy signal that's still in effect. We bought some SPY spreads based on that. The red letters are successful buy signals based on that. The blue ones are not. And we have a very specific trading system based on this. At the bottom are the two buy signals shown there. Those are trend of VIX. In other words, we define the trend of VIX as being bullish when both VIX and its 20-day moving average are below the 200-day, as happened right there. And that happened again, right there in October. Now we're very close to that happening again. The 20-day and the 200-day moving average are right on top of each other in this scenario, and they're right in here. They're very close together, so I wouldn't call that one way or the other yet. But this could give a buy signal here coming up soon. So the spike peak buy signal is in effect. The trend of VIX signal is still in neutral at this point in time. Now VIX is getting low again. It's down to 16 or so, and people get worried when that happens. But a low VIX is not the problem. It's a problem when it starts to rise. So we have ways of looking at that. And you can't trade VIX, but you can trade the VIX futures. So this is the term structure of the VIX futures. In a bull market, they slope upwards in price and everything is perfectly fine if it looks like that. But in a bear market, this happens. And it happened here in October, and certainly happened a lot last April, but it really happened in the pandemic or in the financial crisis, things like that, where you can actually make a lot of money off an inverted term structure like that. We haven't had one of those last for a while in quite some time. You really probably don't want to see that. It's not a pretty market when that happens. But here's from this afternoon. The prices. VIX was trading at 1606. I said it's down here 16. And here's the futures. And you can see that each futures contract is trading at a higher price than the previous one. So they all have a premium over here in the right-hand column. They all have a premium to VIX, and that's fine. We see that. So this whole concept right here is pretty bullish. The term structure is sloping upwards. The futures have a premium. Everything is great. Now you can quote the futures delayed on the CBOE website, and you can also quote the indices that the CBOE computes. They have volatility indices. There's 6 of them here, and again, you can see their prices again this afternoon, and they all slope up. Each one is higher than its predecessor, its shorter term predecessor. So the term structure slopes upwards over time. Again, bullish. So, the construct here is pretty bullish. We had a little scare there between November 17th and 21st when it looked like the term structure was going to invert, but it really didn't. And so the thing we watch, for early warning sign, I guess you'd say, we look at the price of December versus the price of January. And right now, January is trading comfortably higher than December. That means the term structure is sloping upwards, and that's bullish, and everything is good. But it did go negative back there in that November 20th, which was a brief scare, but the market recovered quickly, and that was one of those times. It sold down to 6,500. So realized volatility is something else we pay some attention to, and I showed you in an earlier chart how it exploded on October 10th. So that was a sell signal, and realized volatility has remained relatively high. The 20-day historical volatility of S&P right now is still 15%. That's certainly not low. Something below 10 would be low. So it's showing a little bit of nervousness in the market, and as I said, the market has oscillated back and forth in its trading range. That's partly what's caused that. So everything seemed negative back in October when we really got an inversion in the term structure. Things looked pretty dim. And when those same things happened back in 2018, 2020, 2024, they resulted in some rough market conditions, but not this time. So, I guess we escaped a bullet there. So here's how the indicators stand. We have 3 neutral indicators, just to summarize. The chart of S&P, the McMillan volatility band does not have a signal. Trend of VIX does not have a signal. So those are all pretty neutral. Realized volatility is a little high, so that's sort of towards the bearish side. And the equity-only put-call ratios are on sell signals. But these other things are all bullish. New highs versus new lows. We saw that. Even though it's had a series of signals, it's bullish now. We're on the spike peak buy signal. The breadth oscillators are, as I said, the New York Stock Exchange, or the stocks only one is still bullish. So I didn't put it all the way over to the edge because the New York Stock Exchange one is not. And then we just saw the term structures. Those are bullish as well. So we're in a trading range, and we have mixed signals. That's going to happen in a trading range. But we trade each one. Each one has a system built on it. You'll see in our newsletters. And they're another thing that we do is we roll an option when it gets to be 8 or 10 points in the money, SPY or others, and that helps put some money in your pocket and keeps you from getting wiped out on a quick reversal back to the other side. Now we're coming into a seasonally bullish period, and I mentioned this. and we will be covering all of these seasonal patterns that exist. They just started now with the week after Thanksgiving, and it will continue on to the Santa Claus rally just after Christmas, and then all the way through January. So these will all be covered in our newsletters. And that brings me back to the thing I showed at the beginning. If you go to this URL, you can subscribe to our top 3 newsletters, 1 month of each, for a total of $99. That's a big savings off the $642 retail value. And you don't have to take them all at once. It's probably information overload. You can take them simultaneously. I mean consecutively, so take one, then the other, see which one you like. But they all cover most of these indicators, and they cover all these indicators, plus quite a few other things. And the option strategies, for example, we do quite a bit with earnings, buying straddles around earnings, that kind of stuff. So the track records are on our website if you want to poke around there and take a look at those. And meanwhile, we do have a new website. We just actually moved it. So if you're a subscriber, you notice we were down over the weekend. We were moving hosts. And we also have a YouTube channel with a weekly recording, market prediction recording, and well as a couple of other newsletters. So that's our contact information. Go to optionstrategist.com/MCMweb for the newsletter trial, and if you're interested in money management, you can go to that website. I just say our minimum account size is $100,000.